Have you heard of velocity banking?
Yes.
Do you understand how it works?
Oh, God. Oh.
In this video, I will share with you everything you need to know about velocity banking. So if you're not sure if you want to join the club or stay far away, make sure you watch this video till the end. Sweep strategy, mortgage acceleration, accelerated banking, HELOC strategy, debt acceleration strategy, all other names for velocity banking. But what is velocity banking? It's a debt payoff strategy that involves using a financial tool like a HELOC to accelerate paying off debt. The most common debt payoff methods are the snowball method and the avalanche method. Then you have the less popular volcano method, and then the infamous velocity banking. Why is it infamous? Velocity banking is often oversold, misunderstood, and risky under the wrong circumstances. So how does it work? First, you need a debt payoff tool, HELOC preferred, because it needs to be revolving and have the lowest interest rates. It's also possible to use a personal line of credit or a credit card. Then you need to determine your cash flow, meaning your discretionary income, your income minus your expenses. In order to figure out your cash flow, you'll need a budget and you need to follow it religiously. If you need help with your budget, you can check out this video up here or look for the link in the video description below. Then determine how often you want to chunk a velocity banking term, meaning a large payment towards a debt. Every 6 months, 9 months, etc. Let's use 6 months. So get your cash flow times 6. This is how much you can chunk. If your cash flow is $1,000, you can chunk $6,000. That being said, you never want to max out your debt tool. The rule of thumb is never to go over 80% of your available credit. It's good to always have a buffer for emergencies, especially if you don't have an emergency fund. Next, you want to check with your loan terms to see if you can make additional payments and check to see if there's a limit. Now make your chunk payment towards the loan. This will go directly to the principal. If it's a mortgage or other installment loan, your monthly payment won't change, but you'll pay less interest and the loan will finish sooner. If you have smaller loans, pay off those loans first to free up cash flow. This doesn't necessarily create cash flow, but it consolidates your loans, hopefully at a lower interest rate. Now, every time you get paid, you deposit it all on the line of credit. Doing this will lower your average daily balance to minimize interest charges. And now you spend everything from the line of credit. To minimize interest even more, you can use a credit card and take advantage of the grace period. Spend using your credit card on all possible expenses and pay off the credit card just before the grace period ends. This will keep your line of credit's average daily balance even lower, on top of earning rewards like cash back with your credit cards. Repeat the process and in just over 6 months, you'll have the line of credit paid off. But why not just pay off the loan directly using the line of credit? Well, the point of velocity banking is that if you have the right interest rates, enough cash flow, and can keep your average daily balance as low as possible, you may be able to save on interest. But is the savings actually worth it? If you had a 25-year, $200,000 mortgage and had an interest rate of 5%, and let's say the interest rate stayed the same throughout the entire loan, you would pay $148,962.87 in interest. But if you chunked $12,000 right away and did this every 12 months, you would save $99,995.83 for the entirety of the loan and pay off your mortgage 189 months sooner. If you instead said, frig the chunking, I'm just going to save $1,000 a month and make a prepayment of $12,000 12 months later, you would save $93,211.24 in interest for the entirety of the loan and pay off your mortgage in 180 months. So with the chunking versus just making payments directly, you would save $6,784.59 in interest and pay off your mortgage 9 months sooner using velocity banking. But wait, what about the line of credit interest? The best case scenario, you'll find a HELOC with a 1% higher interest rate than your mortgage. Well, because HELOCs will usually have a higher interest rate than a mortgage. Once again, with the best case scenario, which is unlikely unless you have a very high cash flow, you can manage to keep your average daily balance to zero. In the life of the mortgage, you will save almost $7,000. The second best scenario, you get paid all your income in the beginning of the month and all your expenses come out at the end of the month. You have the $1,000 cash flow, so you're working down the line of credit balance. You will pay around $400 in interest a year, which equals to around $10,000 for the entire 25 years, which means you paid an extra $3,000 in interest. And the most likely scenario, you have a higher average daily balance because of all your expenses and how your paychecks come in. You will pay even more interest. So you tell me if you think it's worth it. Yes, velocity banking is the quickest method to pay off debt and you will save a lot of interest versus not doing anything. But versus the debt snowball and avalanche method with direct additional payments, it's not much of a difference, depending on the situation. So why does everyone swear by the velocity banking method? They don't. If you go to YouTube, you'll find a handful of velocity banking channels. Fantastic, Denzel Rodriguez, the Kwan Brothers, the Velocity Channel, and a few smaller channels. They all sell coaching, consulting, programs, private groups, and other content with paywalls. And none of them are actual certified financial advisors. And if you watch their videos, especially their older ones, and don't understand where they got their numbers from, it's not you, it's them misleading you. Or they leave out important information that makes it seem much better than it actually is. That only needs to happen once and their credibility is lost, and this should be a red flag. You never see any credible personal finance YouTube channels that promote velocity banking without some kind of gain. It's definitely a topic worth discussing, but is it worth all the hate comments from the velocity banking followers? Hopefully. And you'll notice in the comment section for Fantastic and other velocity channels, there's no debating or negative comments. It's like they disappeared. But if you go to a video that's discrediting velocity banking, it's filled with comments from both sides of the coin. Let's look at some misconceptions. Cash flow. Velocity banking cannot magically create cash flow. There's claims that if you are living paycheck to paycheck or even have negative cash flow, that velocity banking can create cash flow by way of paying off smaller loans with your line of credit or satisfying the minimum payment. You are not paying off your loan with earned dollars. You are transferring debt to another debt instrument. Yes, you don't have the smaller loan payments anymore, but it was a payment that was paying off debt. But now you've transferred it to a line of credit, and now you got more cash flow to pay off that debt. If instead you use that cash flow for expenses, you're paying less debt and will not get out of debt sooner. That being said, this can be useful if you can't afford all of your debt payments. Consolidating them can make your debt payments more manageable, but once again, you are just postponing paying off debt and will likely pay more in interest. And using a line of credit to pay off smaller loans with higher interest rates can be a strategic move that doesn't require velocity banking. Cash flow can only be created when you either make more money or reduce your expenses. And paying off a loan with earned dollars is reducing your expenses. And if you're living paycheck to paycheck or have negative cash flow, but are still making minimum debt payments, you are paying off your debt and you don't need velocity banking. The next misconception, simple interest loans like a line of credit work differently from amortized loans. Yes, this is true. But what's the actual difference in terms of interest charge? If a line of credit and loan had the same terms, the line of credit would actually need a higher payment to keep up with the loan. So if the interest rate is higher on the line of credit, this becomes even more interest. So no, a high interest rate line of credit is not better than a low interest rate mortgage. Yes, with the line of credit and velocity banking, you are making extra payments and getting rid of your debt sooner. But if you just saved up your cash flow and made extra payments, your mortgage may not be paid off as quickly as velocity banking, but you will pay less interest. And there's no such thing as amortized interest. There's either compound interest and simple interest. Also effective interest rate or true interest. Yes, if you have a 10% line of credit and pay it off in 6 months, really your interest is 5%. And yes, with a mortgage, you may end up paying double of what you bought your house for, but if you forego the line of credit and make extra payments, you will greatly reduce the interest you pay. And lastly, there's no magic. Velocity banking can only save on interest by keeping your average daily balance lower. That's all it is. Your success with velocity banking will depend on how effectively can you keep your average daily balance low. And this isn't easy to do, especially if you have low cash flow. And if you have high cash flow, you can just make extra payments without all the extra work. Velocity banking isn't a scam, and it isn't debunked, but it is marketed deceptively and often misunderstood.
I don't know, but it sounds great.
Velocity banking can be a faster way to pay off loans and save on interest, but it will only work for the right person in the right situation. You must be disciplined with your budget, you must have high cash flow, you must be able to get the most favorable interest rates, and you must do the math and make a comparison of velocity banking versus just making extra payments and see which one is better. And decide if that savings is worth doing velocity banking and worth increasing your risk. Even if velocity banking does cost you more in interest, if it's a strategy that can help you pay off your debts sooner, don't let anyone stop you. Just make sure you educate yourself as much as you can, not just in velocity banking, but in all aspects of personal finance. And you can do that by watching one of the videos on the right of the screen. See you there.